Welcome to Theo Trade. This is Don Kaufman. June 17th, 2020. Few minutes left inside of the trading session. The S&P futures are down some 14.5 handles. Still, though, quite the range, including some of the overnight trade. I mean, come on. Today we had a range all the way from 31.47 down to 30.94. Hey, 60-point S&P range cannot be wrong, which brings me to kind of the theme of this evening's video, and that's this. Heavy volatility, you better believe it is still lurking for the remainder of this trading week. Let me show you why I see still very expansive ranges coming into Thursday and, of course, Friday of this trading week. Now, for those of you maybe that are unaware, we're coming into what is categorically kind of called the quadruple witching. And what that has to do with is, the futures. The futures are actually rolling right now. If you're unfamiliar with some of the futures contracts, well, you should get familiar with futures contracts. All right, we're rolling off June into Sep. Not a huge deal. There's some decent volume, obviously, still in the June futures contract. The roll to Sep. Sep has picked up 1.7 million contracts. Can't be wrong. Nevertheless, during this quadruple witching, so we have futures that are rolling over. Then, of course, you have equity options, okay? All of your equity options, let's say something like Microsoft, those are going to expire. Then you have index options. Index options, of course, like the SPX, those are going to expire. What else you got? You have a product called single stock futures that no one has traded, like, ever. So whenever somebody says quadruple witching, I'm like, no. You mean triple witching, because nobody ever trades single stock futures. Nevertheless, okay, this has always been thought of as it's a more volatile time. It's the triple witching, the quadruple witching. I'll counter that. It's not necessarily more volatility. Almost everything that's rolled these days, an expiration. I mean, come on. The SPX has expirations, what? 3 times a week. You have a Monday, a Wednesday, a Friday expiration. Expiration is a big non-event right now. And yeah, the futures are rolling forward, but people, I don't put that much weight into this idea of the triple witching, quadruple witching. The one thing, though, that you do have to be careful, okay? If you're not familiar with this, watch out if you're short calls, not puts, but if you have sold calls and they are in the money on something like the SPY pays a fairly hefty dividend, that you do have to watch out for. But let's put that aside. Of course, we'll talk a little bit more about the SPY dividend here at Theo Trade. We'll be talking a little bit more, of course, about the futures contract roll on Thursday and Friday as it actually occurs. But let's get down to business, because I made a pretty large statement there. Listen, heavy volatility, it's going to be lurking throughout the remainder of this week. What do I see inside of the marketplace? Well, first of all, the S&Ps, they're going to close down today, but this is kind of a mild trading session in terms of effectively closing down. The S&Ps are going to close down what? A whopping 13 or 14 points, which is a big nothing burger. And it's a big nothing burger, though, just given the range we've had. I mean, come on, people. This is a 60-point S&P range. Yeah, it includes overnight trade, but hey, listen, lately, overnight trade has been a rocket. I know I've said that before, but overnight trade, it's kind of like where it's at. So the marketplace is going to finish nominally down, which is going to snap a 3-day kind of move to the upside. But something with that move to the upside, throughout the course of the move to the upside, there was staggeringly high correlation. And I want to take you into a little bit of detail of what that kind of means. When I say staggeringly high correlation, during this move that we saw over the previous days to the upside, we were like 95 stocks trading to the upside, maybe 5 stocks to the downside. Even at a point yesterday, we had 101 stocks in the S&P 100, 101 to the upside. If you're not familiar, Google actually has 2 places in the S&P 100. So for the most part, you had every single stock trading to the upside. Today, big contrast. Today we actually have what I kind of term, there's the closing bell. Today we have what I kind of term a little bit of a slop fest. Slop fest! It's 35, 65 in terms of the advanced decline line. I would take the assumption that once again we're going to correlate heavily in the remainder of this week. And of course, everybody's like, are we going to the upside? We're going to the downside. Well, let me actually bring you specifically into that. Because of the correlation. I'm going to show you something hopefully you find kind of interesting. We're going to start on the XLF and we're going to apply what's called auto expected moves. And what I want you to see with auto expected moves is here inside of the XLF, which is of course the financials, right? What we did is we actually touched the upper edge of the expected move that was yesterday. We pulled in sharply. The financials really are what took the S&Ps lower today. How did the financials take the S&Ps lower? Well, they sold off. No, it has to do largely predicated because the bonds rallied. The bonds rallied, lowered rates, okay, hurt some of the financials. So the financials tagged the upper edge of the expected move and pulled in from it, okay? But as I said a moment ago, I noticed like the correlations really just the last couple of trading sessions, ever since we had the big sell-off last Thursday, the correlations have just been uncannily high. I mean, again, they've been phenomenally high other than maybe today. The next product I'll pull up is the XLE. This happens to be none other than the energy sector. And in the energy sector, well, the exact same thing. Yesterday, it literally tagged the edge of the expected move, pulled back in a big way. Speaking of which, the energy sector also getting hit a little bit today, but the energy sector is minute in comparison to the market cap of the financials. You're like, okay, I get what you're saying here. Like, two sectors, they hit the edge of the expected move. Yeah, we're not done yet. The next one we're going to bring up, we could bring up the Russell, okay? The Russell, the exact same animal. Now the Russell, okay, wild to the upside. Cracks outside of expected move yesterday, pulls back literally to the edge of the expected move. Today comes in. So the Russell cracks the edge of the expected move. Again, every product for the most part that you're looking at over here. Now we're actually going to cruise over to the QQQ. This is the NASDAQ 100, which is undoubtedly been the strongest of your products as of late. Well, guess what? Hits the edge of the expected move yesterday, kind of moderates, tags outside of it, and ends today on it. I mean, we are literally, people, if you want to really zoom in on here, we are spot on the edge of that expected move inside of the QQQ. Okay. What I'm getting at here, and by the way, I'll do last but definitely not least, again, we can take a look at the XLP. The XLP, okay, very, very similar animal, ending pretty much right on the edge of the expected move. Almost every sector that I bring to you, okay, we're literally tagging the upper edge of the expected move, okay, and pulling back. Now, okay, I'm going to cruise back over to the QQQ just to make a quick point with the Qs. This becomes, because we're hitting the edge of the expected move, becomes an extraordinarily dangerous time. And it's one of the reasons that, as I said, heavy volatility is going to lurk in here. The market's been having some fairly phenomenal ranges, okay? When we're at the upper edge of the expected move, the higher probability trade is without a doubt that we pull back inside the expected move, right? So we pull back somewhere inside of this expected move. We end the week, okay, inside of it. Everybody goes home happy for the most part that sold some premium in here, okay? The risk, though, is an explosion outside of it, where we actually get like one of these 2 sigma moves. So you take the expected move and literally double it. And because we have all of these major sectors literally hinging right on the upper edge of the expected moves, it really makes it that much dangerous for the marketplace. Now, I'm also going to put this in context, okay, and I'd like to actually look at the SPX, okay, because one thing that also really resonates with me, the S&Ps, they actually did not tag the upper edge of the expected move. Nevertheless, they came extraordinarily close to it, within a hop, skip, and a jump away from the edge of the expected move. Okay, so to further this, when I'm talking about volatility, the edge of the expected move, okay, I think most people understand because we're at that kind of key inflection and we're right at the upper edge of the expected move, as I said, it makes the market that much more dangerous. We break outside, you get the wild 2 sigma move. For the most part, though, you should be fairly mellow inside here. Yeah, until, of course, you start to actually look at the volatility, right? What's the volatility saying for the remainder of the week? And you know what? I probably could have just come over here and said, yeah, the volatility is this, not a problem whatsoever. That's why we're going to be a little bit more volatile. But we're actually facing relatively high, okay, expected move, even from now, which is Wednesday night, into Friday's close. You're still sitting on approximately here, we'll call it a $63 anticipation of movement. Okay, so what? There's $63. All right, well, you have to realize, first of all, this entire week, we were looking for a $125 move higher or a $125 move lower. So we passed through a couple of days. We see some fairly extreme volatility, and we're still left at this point with $63 of movement higher or lower, which again is quite considerable given the fact that, maybe you have the anticipation volatility is going to die down. This $63 move, coupled with the fact that you have the entire marketplace just pinned at the upper edge of the expected move, okay, really at this point in time leaves us incredibly uneasy. And that, again, the higher probability trade is absolutely unequivocally back inside the expected move. That low probability trade, though, looking for the 2 sigma move. As such, some of the trades that we might look for, really short-term stuff, okay, could be like a back spread for the 2 sigma move. That's something I'm actually going to cover very early on in the trading session. Tomorrow, it's Thursday, June 18th. I'm going to cover it right off the bat because the setup, again, on the edge, okay, right on the upper edge of that expected move is just pivotal for being able to place a back spread. If we get that 2 sigma move, it could be very profitable. If we don't, who cares? The back spread will just go out. Okay, we get to keep a small credit and we'll move on. Thanks everybody for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.